This is TreppWire Week in Review for week ending August 26, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with our experts, Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, stocks rose as investors wait for Fed Chair Powell's comments tomorrow and what it may mean for interest rate hikes. In economic news, revised Q2 GDP contracted less than initially estimated. New home sales dropped 12% last month, but pending home sales had a smaller decline than expected. And more retail earnings gave us additional insight into consumer behavior. Manus, more news obviously will come out tomorrow with PCE and the University of Michigan consumer sentiment. That could impact the Fed sentiment, but where do we stand today?
Wow, it's really tough to get your arms around this market right now. I was talking to somebody yesterday, and maybe because Olivia Newton-John died recently, this was in my consciousness. But there's that scene in Greece where the people from American Bandstand come and do the dance at Ridgefield High or whatever the fictional school is. And when one camera goes on, the entire student body runs to one side of the gym. And then when they switch cameras to another one, the whole student body runs across the gym to the other camera. And I feel like from the investor side of things, that's what it feels like. We get one positive data point where we start to exhale that inflation isn't going to be as bad as we thought, or the Fed will take their foot off the gas. Investors race to that one camera which says risk on, right? They don't want to be the guy that missed this modest dip in whatever it is, stock prices, lower bond prices, wider spreads, what have you, right? The time it takes for people to jump in is very, very small. And when people jump in, it's everybody jumping in. And then if we get a negative sign of some sort, a negative inflationary indicator, a more hawkish Fed remark, everybody races over to the camera that says risk off. And then we see 4 or 5 days of the markets selling off. And so that's what I see at the top of the umbrella among money managers and investors, traders, et cetera, right? That's what it feels like. But when you talk to people on the street and you talk to friends at a cocktail party or something like that, the tone is very, very different. It seems very dour, right? It seems like they lead with expenses just keep going up. Food is out of control. And by the way, 3 more restaurants closed down on Main Street. Did you see that? And you read, the website of these restaurants closing down. The news is heartbreaking. The people say, I've been doing this since 1981. I can't do it one more day, right? I'm working 7 days a week because I can't find employees to fill my shifts. I'm paying more than ever from food. I can't pass this cost on to my employees. I finally have to say, uncle. So it's very hard to get your arms around where this is going. I don't think things are going to turn out nearly as well as when investors are running to risk on camera, but it's hard to ignore what you hear from people on the street right now and not think that there's a leg lower than what we saw in the spring or over the summer in terms of inflationary fears, a hard landing, and so forth. I think that I'm very mixed right now, and I apologize if I'm not giving people a great deal of direction with how I'm feeling, but I do feel that maybe the glass is half empty right now.
I think the camera analogy is a good one, Manus. It's kind of like a yo-yo or a roller coaster where, things smooth off for a little while and then they go down a cliff and you're kind of arms up screaming. But to your point, the narrative has been very hard to kind of put your hand on and just kind of get a feel for what's going to come next. I mean, if you look at the Kansas City Fed President Esther George this week, joined the chorus, for hawkish tone related to the rates. But this was the first time they were on Bloomberg TV saying the benchmark may have to rise above 4% to defeat inflation. So we've been hearing that 3.5. Now we're talking about 4. I think some of that comes back to, GDP being revised down. It went from, the initial numbers were a drop off of 0.9%. They revised that down to 0.6. And then if you look at some of the home sales, which, kind of fell off a cliff when interest rates started to rise, New home sales certainly haven't rebounded. I mean, they were down significantly. It looks like 12.6% in July, which was a pretty significant drop. If you look at the year over year numbers, it's close to 30%. It's like 29.6. But pending home sales only fell 1%, which was significantly better than what analysts were forecasting at 3%. So, to your point, like you have all these storm clouds on the horizon, but like in the day-to-day, things are still kind of, trudging along. And then, out of nowhere, you see something that maybe you weren't considering. I was doing some research for a presentation in our office this week. Like OPEC missed production numbers in July, like 2.9 million barrels deficit per day. Our strategic petroleum reserve is at the lowest level it's been since 1985. So we've seen some significant relief at the gas pump, but are there some longer term consequences based on lower production and maybe targets being missed that are going to rear its head? You mentioned some of the food price. And, I think we've become so desensitized to it. I was watching a Domino's pizza commercial this week, and they used to have a coupon where you could get 2 medium pizzas takeout for $5.99. Well, now they're $7.99. So if you look at the percent change on that, it's pretty significant. And so, you're starting to see some of these retailers, inventory is up for them year over year significantly. We talked a little bit about that last week. Macy's, as an example, they reported inventory levels up 7% from prior year. And we're really starting to see a slowdown in some of that discretionary spending. So I'll let you kind of get into some of the retail earnings. But to your point, I don't think we've seen the worst, but I don't have any clear feel for when that's going to happen.
Yeah, I think in my case, I had 2 additional thoughts. One is there definitely is some recency bias here. We saw a whole lot of retail earnings this week. They tended to be more negative than positive by a fairly hefty margin. Just on a personal level, a lot of these restaurant closings that I saw were in my immediate area, and I only saw them this week. So you do have that immediacy bias. That could be a factor in what I'm thinking. But, I was also talking to one of our colleagues that we've had on the podcast before, Steve Bushbaum. And one thing he pointed out that I hadn't thought about before, he really dives into the economic numbers to a great extent. We have to get him back on here again. But he was talking about the wildfires in Europe and the US and what is expected to be a dismal crop yield this year, right? Which will obviously push up the cost of food. But as he pointed out to me, we use so much corn to produce ethanol that would push up the cost of gasoline as well, right? So, when you take this all together and you look at it, I'm normally a glass half full guy. For the entirety of the summer, I've been saying, I think we see a recession, but I think it's not 2008 like. I think it's a mild recession in comparison. Not that there won't be pain, there will be, but hopefully it's not as painful. And now I'm starting to doubt that thesis a little bit. Hopefully it is the recency bias and we start to see more green shoots coming down the way, but it just felt a little, maybe it's because the stock market was so exuberant for several days in a row last week, right? It could be any of those things, but I definitely have that same pit in the stomach I get when I know my wife is coming home from vacation and there's pizza boxes everywhere and, laundry's piling up, not just in the laundry room, but in the family room, and the dog has lost 4 pounds.
There will be a reckoning.
There will be a reckoning.
So I did want to make a comment before we dig a little bit more into retail, and you made me think about it when you were talking about energy. And that is the story that came out this week that predicted that 1 in 6 American homes may have some trouble paying their utility bills because they've already fallen behind. And that was according to the National Energy Assistant Directors Association. So that was a pretty troubling statistic.
Yeah, I think we've seen this in other areas. I think you've covered it before, Martha, in terms of phone bills as well. I think about a month ago, we were talking about one of the big phone service providers talking about similar double-digit numbers of people that are falling behind in their payments. And I think that's a big tell. And I think that has a lot more impact for me because it touches so many people than maybe a Dollar General earnings or a Kohl's earnings, which we'll talk about in a little while, right? Those are big companies that will survive. They may disappoint their investors, but they'll muddle through. But when you're starting to talk about people that can't pay their phone bill or can't pay their heating bill, and by the way, we might see higher heating bills this winter, that takes on a very human face. We got to keep our fingers crossed that the Fed gets this right.
So let's dig a little bit into some of the earnings. It seemed that despite beating some expectations in some cases, retailers were struggling with some bloated inventory issues and consumers that were buying different things than they were about a year ago.
Yeah, it really runs the gamut from high-end retail to the everyman store to the low-end dollar store type person to apparel, right? It was really across the gamut of retailer types that we saw. And we're recording this on Thursday afternoon, 8:25. And just a few moments ago, we saw the headline come through that the Gap was pulling their guidance and we're citing weak sales in Q2 from Old Navy. So I haven't dug into the details on that, but that became the latest one today to kind of warn people that things are not hunky-dory out there for the retailers. Other ones that we saw, and to your point, Martha, sometimes the earnings were good. Sometimes they beat on the top and bottom line. And yet it was the guidance where they said, we're going to have to discount heavily to get rid of this stuff, right? We're sitting on bloated inventory and we're going to discount it heavily and we're going to refresh our inventory to get ready for the holidays. And that would include Kohl's, right? Kohl's has had a lot of problems, right? Their stock price was up in the 70s. We thought they were going to get bought by private equity. Everybody was fat and happy. And next thing you know, disappointing sales numbers, private equity pulls back. Stock is now down in the 20s, if I'm not mistaken. Nobody wants to touch Kohl's. And now they have, in their own words, their middle market consumer is struggling. Another today, Dollar General, right? Their stock was off 10% today. That had been one of the stalwarts on the upside recently, those dollar stores that had been attracting foot traffic for people trying to save money. Apparently, Dollar General is losing traction to those bigger guys like Walmart and Target that offer food or more food choices. Target themselves had 1.5 billion in inventory that they need to try to shed. And Nordstrom was messy, right? They too had weaker sales than expected and concerns about the consumer. So not a lot of positive stories out there.
The one thing across the spectrum was glut of inventory, greater inventory. And I think just to highlight Macy's and Nordstrom, Manus, Macy's said they actually had some surprising news in the sense that they had more shoppers coming to their brick and mortar stores as e-commerce revenue was actually slightly down. They were at 30% of total sales in the quarter, down 5% from the previous year at Macy's. And then Nordstrom, their CEO was quoted as saying customer traffic demand decelerated significantly beginning in late June, predominantly at Nordstrom Rack, which is interesting because we actually had a story about 6 weeks ago where they were expanding their Nordstrom Rack physical store presence. So I think this just shows kind of in your intro where we talked about not really knowing which direction the market is. These stores are just as confused, it seems like, because some of their strategies are not paying off. Some of their, e-commerce transactions have fallen off while brick and mortars increased at Macy's, fallen off at Nordstrom. So there's not really a pattern here other than everyone has too much inventory and prices are going to have to come down.
Yeah, I think they're having a tough time figuring out which way the wind is blowing in terms of how to prepare for more supply chain issues, how much to have in their stores, how much to pay for it. Will they have more supply chain issues and inventory challenges getting new things? How challenged the consumer is, right? How much discretionary money they have to put to work? And which way is the cost curve going? If it's going higher, you make one decision. If it's laying low and staying flat, you make a different decision. I wouldn't want to be a buyer for a Macy's or a Nordstrom these days. I think that it's a toss-up whether you get this right or wrong.
And we had a couple other retailers that announced this week, and they end up kind of showing up in some of our other stories. Peloton, for example, Bed Bath & Beyond, Victoria's Secret, some of the other ones that announced very lackluster results.
Perhaps my dour mood today is this recency bias that comes with these these negative headlines coming out of CNBC and Bloomberg every morning or every afternoon after the bell. But it did seem like, I mean, I try to connect the dots. If they're struggling, the consumer is struggling. If the consumer is struggling, the U.S. economy isn't on as firm footing, perhaps as we thought, right? The consumer isn't as flush or confident or robust as maybe we thought 2 months ago. And that's certainly impacting my mood today.
I did see that Peloton had announced today that they were going to be selling on Amazon now in a way to try to get broader distribution and reach more consumers. And they were going to lean in a little bit more on their rental business. So you could effectively, rent the machines and subscribe to the content in a rental fashion versus having to purchase the bike. And so, we'll see if that has any market moving capabilities for them, or if it's just another, announcement that goes bust for them.
I was out with a client this week down here in South Carolina. He just happened to be in the same neighborhood I was the last couple of days. Somebody I go back with more than 20 years. And he was saying that you can't give away a Peloton these days. It used to be the secondary market was quite strong, that you could get almost what you paid for it, trying to sell it on the secondary during COVID. And now you can't give them away, and that's not a good sign for the firm. We did have a story this week, it's more in the office segment, but I'll throw it out there now. Two different ones, actually. We had already reported that Peloton was looking to shed 100,000 square feet on 9th Avenue in Manhattan in a big building where they have 300,000 square feet. They came out this week and said they were also going to try to give back 100,000 square feet in Austin. So they are very aggressively looking to reduce costs. And they had terrible numbers today, if I remember correctly, that their numbers were awful. But beyond that, in a little bit of coincidence, Lyft this week also announced they were trying to get rid of space in Seattle, Nashville, San Francisco, and New York. Lyft shares that building. They're the two biggest tenants on 9th Avenue. And so there you have Peloton, who's, them not being a going concern in 2 years is not out of the question, right? I mean, there'll always be a Peloton, but they may have to go through a restructuring because they're burning cash so fast. Same thing with Lyft. And they are the two dominant tenants on that building at 34th and 9th, right? So if you're, and I believe Lyft has a termination option. So not a good story there.
So while we're on the subject of retail, let's dig into some stories that are actually kind of big stories this week.
Should we start with the positive or the negative? I'll let you decide, Martha.
Let's go with positive. Change it up.
It's no surprise to anybody that's been listening to our podcast or reading our TreppWire stories that the big retailer Unibail-Rodamco-Westfield has been looking to exit the mall space in the U.S. If I'm not mistaken, they own 23 malls in the U.S. They wanted to shed those holdings. That news came out in the spring. We got a really big story today, which I thought was a real green shoot. And that is the firm was able to sell the Westfield Santa Anita to an undisclosed buyer for $537 million. So this is a terrific story on several fronts. On one front, the 537 sales price is 88% of what the mall was valued at in 2012. So whereas we've seen a lot of retail and malls lose 40, 50, 60, 70% of their value, this one is only down 12%. Great news. Even better, the property backs a $285 million CMBS debt package, which is split between two 2013 deals. Those loans should now pay off, those loan pieces, in the near term. The loan matures in February of 2023. It became open to prepayment this month. So now that loan should prepay sometime in the next month or two, I would expect.
Yeah, that's a really good story, Manus. That one actually came from our CRE Direct publication that we mentioned frequently on the podcast. One of the benefits of stories that come from CRE Direct is a lot of times they're plugged into our operating income and expense data that we track on the Trepp system. So in this particular deal, the property had generated about $9.8 million worth of NOI through the first quarter. So if you were to annualize that, you'd get about $39 million in NOI for the year. And based on the purchase price, that would give you an in-place cap rate at the time of sale at about 7.29%. So a really, really good, strong cap rate for a mall that a few months ago we weren't sure would be able to be sold out, anywhere close to the previous valuation. So all in all, a really great story on this one.
And the other trading alert, not quite so positive.
This came out late last week, and we put a trading alert out Monday morning. The story was that Regal Cinema's owner, which is Cineworld, was planning to file for bankruptcy. Cineworld is a global company. Regal Cinema is their US arm. They were planning, I think, to liquidate assets in many other countries. In the US, they were planning to go Chapter 11 with Regal Cinemas. Why is this such a big story? Well, it's a really big story for the CMBS market. There are about 75 loans with exposure to Regal Cinemas. Often Regal Cinemas is the third or second largest tenant. They take up a lot of space. In some cases, they are at malls that are already somewhat cuspy. There's a Regal Cinema in the Destiny Mall, which already has had to be restructured and has seen the value of its collateral really slashed over the last couple of years. There's also a Regal Cinema in the Westfield Citrus Park, which makes up almost 11% of a 2013 deal. So, and in that particular case, in the Westfield case, DSCR is already under 1.0, right? So this is the kind of thing that could take a great mall and make it look just okay, which is not terrible for CMBS investors. But the bigger issue is it makes a mediocre performing mall tip over to under 1.0x and makes it either harder to refinance, or it's the straw that broke the camel's back for the borrower making payments each month. They kind of throw up their hands and say, that's it. To be sure, Chapter 11 doesn't mean that all of these will close. Chapter 11 will mean that Regal Cinema will have the right to reject these leases. It doesn't mean necessarily they'll reject all. It could be a very small percentage, 10 or 20%, but if it's in a cuspy loan, it's kind of binary, right? It turns a positive cash flowing asset to negative, perhaps. And those are the ones to watch.
Yeah, it's interesting here, just to give some context to the total exposure. We have about $4 billion in CMBS loans that report Regal Cinemas as a top 5 tenant. And one of the benefits of being a Trepp client, if you are, is we actually take these negative stories when bankruptcies have been announced, and we map all of the exposure in a section on our platform called Loans in the Spotlight. So you can go to the Loans in the Spotlight page. We've already updated it for this Regal Cinemas, and you can actually see all of the properties that could potentially be affected by this news.
So let's pivot to office. But before we do, I did want to comment on a story that was in the Real Deal this week, and it was basically breaking down CMBS with Manis being interviewed. Actually, it was a very nice interview, Manis, from our friend Rich Bachman at the Real Deal. Talked about a lot of the volatility in CMBS over the last few weeks and months, and the genesis of it and the effects and all of that.
I think Rich is a terrific reporter. I think a lot of these guys that cover real estate and CMBS are, but Rich is, in this case and in every other time I've dealt with him, he was really willing to get into the nitty gritty of what is not the easiest subject matter to explain when you're talking about liquidity and bond spreads and issuance and stuff like that. And he manages to take a kind of nettlesome subject matter and make it sound easy. So always a pleasure working with him, and look forward to doing it again.
And worth a look. So if you're interested in that story, we can send you a link to it so you can check it out. One other story, let's dig more into office. Our friend Conrad Poutier at the Wall Street Journal was talking about office space and did a nice piece that talked about how empty office space has been decades in the making. He says it started with a 1982 change in the tax code and continued onward from there with a number of different things that we've talked about many times on this podcast.
Yeah, it's something that people don't really get their arms around very much, right? We've talked about, and Lonnie was, kind of the first to put this out, that offices could very well follow the same path as malls did. But people tend to think that malls and mall defaults and big losses are a recent issue. But we've really seen 60 and 70 and 80% losses on mall loans going back to 2004, right? Things become obsolete. A new mall comes into the neighborhood. All the big tenants move to the new mall, and this thing ends up selling for pennies on the dollar. Sometimes it doesn't even survive as a mall. It gets plowed over, or it sits, empty for years. So these things do have long evolutions. And, we did see a decent number of offices have to get restructured during and after the great financial crisis, right? If you lose a big tenant and your building is dated and your prospects are not great, and you don't have a deep-pocketed owner who's willing to refurbish a place and put a lot of money into a building, those are the ones that suffer. But he's absolutely right that this COVID certainly changed the direction and the pace at which things were happening. There's always a level of obsolescence in any property type.
Yeah, so to put my professor hat on real quick on that, there's a couple of concepts here that I think we're seeing in real time play out. And one of them, there are 4 factors that generally are associated with the creation of value in the CRE marketplace. It's an acronym called D.U.S.T, which is demand, utility, scarcity, and transferability. And you've seen a shift in some of those as it pertains to office from the COVID-19 pandemic. The demand is significantly different. And not just the demand, but the utility of the offices is significantly different. Those two things in conjunction really drives the value of the buildings down. And so we're going to see tenants changing their behavior and their habits. And so we're starting to see that play out. I think on the lender side that you mentioned, Manus, there's a theoretical concept of value between what we would call least fee value and fee simple valuation. So least fee value would imply what is the value of the asset based on the current contract rents, without regard to whether those rents are actually reflective of market rents or not. Fee simple value would indicate what is the value of the asset today based off of prevailing market conditions and prevailing market rents. And so I think what we're seeing here, as these offices come up for maturity, as these offices come up for refinance, is there's a huge delta between what the least fee value is with the current rental rates per contract and what the new rental rates have to be underwritten from a lender's perspective. And so until those things come back closer to equilibrium or closer to each other, you're going to see this really large divide in terms of, what maybe an NOI looks like. And this is very applicable to the mall scenario you gave, where, forever malls have had maybe 70% occupancy, but their major tenants were still paying a large portion of the rent. They had co-tenancy clauses, so the operator was willing to make concessions and keep those larger tenants in place. So on paper, they maybe looked okay, but when you dug a little deeper, you saw how close to the brink they were. The same thing can be said for a lot of these offices. Their P&L may look okay, or the operating statement may look okay today, but as soon as that one tenant doesn't renew, it just falls off a cliff. And so it's interesting to see how some of these theories actually play out when the market shifts. And I think that's where we're at in the market cycle right now.
Yeah, I mean, the most amazing thing for those fairly new to the market among our listener base was back in 2006 and 2007 when we saw this trend, which didn't last long and resulted in enormous losses for CMBS investors, CMBX longs, and others, where the in-place rents were perhaps $40 a square foot for a New York office, let's say. But the market rent at the time this borrower was looking to refinance was $100 a square foot. And the lender was giving the borrower full credit for the execution that had to take place to flip the $40 guy to $100. So if you had done it on an in-place basis, let's say, you might have said, well, this building is worth $500 million. But because they did it on what was known as pro forma rents, the lender lent, in some cases, 1.4 billion or 2 billion on a property with the expectation that a business plan could be executed. And then when the economy started going south, it was very much like the residential side of The Big Short, right? That people bought things, they thought it would always go up. that rents would always be there, that property values would always be sustained. And just like in the residential side, there were losses of, billions and billions of dollars. So hopefully that's a mistake we never make again.
Class is over. Lonnie, is that tonight's lecture, by the way?
No, tonight this is the appraisal class this semester. So there will be some appraisal theory talk, but we're not going to jump right into lease fee and fee simple discussions on day one.
We give the kids a break. So, Manus, we have a couple of stories. Let's start with a couple green ones.
So we'll try to run through these quickly. There's no rock we won't overturn looking for news that touches the CRE market. This is from Charlie Zavalik of the Bernardsville News. That's in New Jersey. AT&T is praying to relocate its employees from its existing massive office complex off Route 202 and Route 206 to a smaller vacant office building within the same township, which is Bedminster, if I'm not mistaken. Why did this catch our attention? Well, this particular property was once almost completely occupied by Mallinckrodt, which was the opioid maker. Because they were the opioid maker, they got sold. They went into bankruptcy. They rejected this lease. This property was almost 100% vacant. The value of the property was cut by 2/3. It was looking at a discounted payoff. And now the owner of that property has nailed AT&T as a new tenant. So this is kind of a mixed green. The good news is this property will get backfilled. The bad news is AT&T is reducing its footprint in New Jersey. Next one from Linda Lindner of ROI, New Jersey. Onyx Equities owns a building in Morris County that's also in New Jersey. They've just landed Morgan Stanley and Zealous. Between the two, those two firms are taking about 170,000 square feet, leaving only about 23,000 square feet in that building. In New York City, this comes from Globe Street. Law firm Freshfields, Brookhouse, and Derringer has signed for 180,000 square feet at Silverstein's Three World Trade Center. Why did this catch our attention? The law firm currently has 140,000 square feet at 601 Lex. Their new lease is for 180,000 square feet. So a rare uptick in the amount of space a law firm is looking for. So we like those types of stories.
I was just going to comment on the Onyx Equity story. That's a pretty good story, not just because landing the two tenants, but to your point earlier of executing a business plan. They made a $50 million capital improvement plan on that property, started a gut renovation in 2016, and they're really starting to see those improvements pay off with these new lease signings. So, that's a good story just to showcase that, you can buy a building, do some renovations, bring it up to, a fully amenitized or modern status, and then, benefit from those amenities in the form of landing larger scale tenants on long-term leases. So just another little anecdote for that one.
We should do a field trip. Martha should take us to that Onyx building. She should take us to the Garden State Mall. We can go to the Xanadu, the Dream Mall, whatever that is by Giant Stadium.
A lot of
Maybe
hot
we'll do it.
spots.
Maybe we'll fold it into a Giant game. We'll go to the mall for the morning and then tailgate for a while and then go see if the Giants are any better this year than last. What do you think? Will our CFO let us expense that?
Oh, absolutely. Yeah.
Primary research?
It's field research. Absolutely.
Lonnie, we're going to put you on that indoor ski slope at the Dream Mall. We're going to put you on with one of those, heavy duty kids bicycle helmets and see how you do. We're going to let you be the Trepp guinea pig on the indoor ski slope.
You might have to do those, when parents take the kids on the little leash down the mountain. Yeah, we might have to do that for Lonnie.
Yeah, give me a Trepp GoPro. We can film it live and post it up when Haley does the podcast. You guys can hear me screaming. Yeah.
So I've got some crabgrass stories. We should plow through some of those.
Okay, so here we go. The first one we'll talk about is in New York. Also, we seem to have a very New York, New Jersey centric podcast today. The Commercial Observer and others were reporting. This is Celia Young at the Commercial Observer. KPMG cutting its office space by about 40%. This also could probably qualify as a mixed green. KPMG is moving from several Midtown offices, primarily 345 Park, but also 560 Lex and 1350 Avenue of the Americas to Brookfield's 2 Manhattan West. They've signed a 20-year deal for about 450,000 square feet. Why do I call this mixed green? Well, my assumption is that KPMG is probably paying just as much money now for the space in the new office than they were paying for those other 3 offices, which were legacy, probably leases that they signed at least 10 years ago, if not 20 years ago. So the spend is probably the same, but it does bring up that specter of, the buildings they leave or will be leaving are those 1950s and 60s Midtown, Park Avenue, 6th Avenue corridor buildings that may be hard to fill. And when you do the math, when it says they're reducing their square footage by 40% and they're taking almost 500,000 square feet, it means they're giving back about 400,000 or 500,000 square feet. And that's a lot of space for Midtown to absorb, not to mention the fact that it's not far, at least in the case of 345 Park, from JP Morgan, which has already said, once their new building opens, they plan to reduce space in Midtown at other locations. So that's not a good one. In Chicago, Danny Ecker, another great Chicago writer from Cranes, he said Caterpillar is looking to sublease its Deerfield headquarters. Not an enormous surprise. Caterpillar a few months ago announced they're moving to Texas. The firm is offering up almost 120,000 square feet at 510 Cook County Road. We talked about Peloton and Lyft already. Go through 2 more. In Chicago, a big 2017 vintage loan went to special servicing. This is backed by 460,000 square feet of space at 333 South Wabash Avenue. It backs a $105 million loan that backs 2 2016 CMBS deals. The problem there was that the property had Northern Trust with just over 100,000 square feet. NT gave that space back in 2000. DSCR has been lagging, and now the loan has made it to special servicing. And lastly, in Pittsburgh, Citizens Bank is going to move to the Gateway Center property in the Steel City. This is kind of a mixed green. On the one hand, they're vacating 525 William Penn, where they have 100,000 square feet. They will be taking up 60,000 square feet at Gateway Center, so another 40% reduction in space. So what is the mixed green part of this? That 525 William Penn has really kind of struggled over time, and this is another big loss for that part of the city. The green part of it is Gateway Center. It's DSCR on what is a sizable loan, $100 million loan, had been under 1.0x substantially as of March 2022. Occupancy was 67%. And since then, the owners have added 3 tenants, 2 by new lease and 1 by renewal, to kind of stabilize this property. So a little bit of mixed bag there, but that CMBS loan that backs a 2013 deal might just muddle through.
Our programming note, we're releasing our secondary MSA rankings of the top 25 performers. That should be released next week. And it's by far one of our most popular pieces of research that we publish.
Yeah, this will be a really great read for the listeners out there. This year, the ranking methodology has been tweaked and improved. What we feel like captures a more modern looking commercial real estate market, considering all of the factors that we talk about on the podcast. One of the major data additions to that formula is now we've included the CRE CLOs to the equation. So it's going to reflect the changes in recent years issuance, which we've talked about over the last couple of months, of how if you look at CRE CLO issuance in 2019, 2020, and 2021, there's been a huge delta. I think 2019 was around 25 billion. 2020 was, somewhere around 15 billion, and then 2021 was actually over 40 billion in issuance. So having that data added to the analysis will make for a really nice report. And we're going to give you, a preview here. I can tell you the top one is not Austin. So there's been some changing in the rankings from the last time we did this.
No, but Tampa did make the top 10. And as everybody knows, we had Rachel from the Bank of Tampa on a podcast a couple of weeks ago. And I got to tell you, by far, she's one of the favorite guests we've had so far. We've gotten a lot of people that said she had some really good color and commentary.
It was a great session. She had a lot to say. And if we ever get into that kind of Johnny Carson mode where we take August off and just, throw repeats out there, I would lean heavily on that Rachel interview to kind of be that filler every Thursday if we, go to repeat programming like they do on the major networks.
Yeah, I would agree. Shout outs. We had several that deserve some mention. Brad B had 6 of his interns listening to the podcast all summer. And you know what he gets for that? We're going to send him a t-shirt. So congrats for that. Jonathan K, just back from college friend's son's wedding on Saturday in Kennebunkport, Maine. He thanked Alani for a fantastic hotel recommendation. And he said he knows Manus prefers the Red Roof Inn, but the hotel bar, the Rumba at the Intercontinental, might be appealing enough for you to upgrade the next time you're in town.
To set the record straight, the Red Roof Inn is a splurge.
No posh cocktail bar with apparently cushy sofas. And on Twitter, Jeff F., a loyal listener, commented on our episode last week. He highly recommended the episode where we gave some color on CMBS. That was Rob Jordan that was on. He talked quite at length about the CMBS market. Gregory P. and Professor CRE, as well as Black Eagle, made some comments. And Black Eagle actually had a Concrete Blonde reference, the song. We were talking about bloodletting, and had a nice throwback alternative song to augment that discussion.
What's going on? Is that the song?
No, man.
Let's hear it.
No, it's not.
You're gonna croon it for us?
No, it's kind of an alternative song, so you need some jangly guitar and some kind of, angry sound to it.
Isn't there big hit What's Going On?
Neath S. reached out for some sentiment survey results. Markets Junkie also asked for that and had some comments that said what's eventually going to happen in the office space and thinking it's going to be about optimizing enough space for the workforce. Tom J. reached out and wanted to be added to our blog. Huge fan of the podcast. JS actually had some verb updates for us. So Martha Ing is getting back on track when we are off on a tangent. Alani Ing is layering Nas lyrics. So I don't know if you have a suggestion for some lyrics, Lonnie.
Yeah, so one of my all-time favorite Nas songs, One Mic, one beat, one stage. He says, all I need is one life, one try, one breath. I'm one man.
There you go. See, that is Lonnie in a nutshell. And then Manasing is making the right CMBX short concurrently while being modest when it played out exactly how you called it. It's kind of like Hannibal from the A-Team. I love when a plan comes together.
That's a nice compliment. It's very nice to hear that. It's one thing I will say is sometimes I'm right on CRE. Our listeners should never listen to my predictions on sports. My track record there is just terrible. Unless you use me as a contrarian indicator, you take my advice and you go the exact opposite. That might be a killer trade, I might say.
And John B. commented on the Rachel Brown Focus on Tampa podcast, and he also added to our parts of speech thread, creating a new noun as a loyal trepper. So thanks, John, for that. I did want to comment that this week's marks 6 months since Russia's invasion of Ukraine, which obviously has displaced millions and impacted many of us at the far corners of the globe. I'm not sure we thought it would last this long, to be honest with you.
Yeah, we have a short attention span, right? This was front and center for about a month, and then it slowly has gone on. But the amount of human suffering is real, and it's not just in the Ukraine. It's people in Germany that are seeing their fuel prices go up or rationing going on, and it may get worse before it gets better. And the whole thing reminds me of something I rewatched The Big Short this week with my daughter, and it took us over 5 hours to watch because every 4 minutes she wanted me to stop and describe what a derivative was and a CDO squared and everything else. So it was fun to do, but it was also quite taxing after a while. But there's a scene in there where delinquencies are going up and two guys are high-fiving each other, and the Brad Pitt character turns to them and says, cut it out. These are people losing their homes. There are people that are going to be kicked out of their homes. There are people that are going to go bankrupt. And while we're profiting off this, it's one thing to profit. It's another thing to spike the football. And I feel that way every time somebody talks to me about waiting for this downdraft, higher food prices to result in lower stock prices so they can jump in, right? It's kind of a real turnoff. And I hope people aren't that guy, at least publicly, which is, I'm waiting for human misery so I can jump in and buy stocks for 20 or 30% less. Don't be that guy. And don't forget that at some point, if food becomes scarce enough, your money's not going to be able to buy any, right? And so we're all in this together. Don't be that guy. Root for all of us. And let's hope that this recession that we're going to go into is modest and the human impact is small. Thank you, Martha, for bringing that up.
With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.